All right, so for paper 2, just give you a quick look at a previous paper. They did Intel. You're not supposed to see the person's name, but he did PDF, so I can't show you. So it's very similar to paper 1. You got to say what was the earnings per share. So look how he did this. Intel reported 21.7 cents, 41 after adjusting for non-recurring expenses. So that's how he did. So the 217 is the comparable number. That's what everybody focuses in on. So most articles, you'll see the comparable number. If the reported number is radically different, you'll just see that one parentheses, and that's all you'll say. You'll ignore that number for the rest of the paper. All right, so that's the key number. And then you look at spam. You get more spam calls. I'm sure they're all important. But... So how much did they beat by? I wish I could have given you Lululemon and Nike, but Lululemon beat on earnings. They beat on revenue. And how did their stock do? Dropped like 15%. So what's going on? So here you're focused on the actual report, but after you do the numbers, so you say the actual number, what was expected, and then the previous year. After you do those 3 things, then you're going to do the same thing with revenue. Actual revenue, expected previous year. And then you're going to do the same thing with margins, gross margins, actual, expected previous year, net margins. So you do the numbers, and then you're going to talk about why the numbers came out like they did. So why is Intel underperforming compared to last year? So he had just a discussion. So Lululemon, the thing that came out was, yeah, they had good numbers, but they have some indication that U.S. shoppers are not going to be buying stuff this next quarter. So it was the outlook. The outlook is what management says. All right. So the outlook can be what some article says. So usually if a stock moves a bunch, you're going to have a lot of people writing up trying to explain why did the market react like it did. So I'll show you another one Wednesday. This one's not exactly, but the market reaction, you can see he put the Bloomberg chart in there. So you do the EPS, revenues, margins, and then you're going to talk about what did management say, what are people in articles saying. You're trying to explain the numbers, not the market reaction. You're trying to explain the numbers. And then you're going to say, how did the market react to this? Was the stock up or down on that day of the reporting? All right, now you can talk year to date, but your focus is on that day. So if you do year to date, that's a kind of a bigger picture kind of thing. So you want to make sure you talk about what the market did that day. Intel was up 9.29 to close at this compared to AMD that was up 2.9%. S&P was down moderately, so obviously that was a really good day for Intel. They're up 9% when the stock market was down slightly. All right, so that's the kind of thing you do. He gave a few too many numbers. So for Intel, I might give the closing price for Intel, but I wouldn't give the price or the price change for AMD or NVIDIA. I would only do the percentage change for other stocks. It's just too much information. And he's trying to explain why did the market react like it did. You've kind of already done that previously because you're talking about what are numbers. So why did they beat on revenues? Was there a particular item that did really well? Why did they beat on margin? Why did they miss on margin? Inflation's been a big deal. Maybe their cost of goods sold was higher than expected. You're trying to just explain it. Every company is going to be different. So you're trying to make some sense of the numbers. Good quotes are always good. Bro, Intel looks to be having success with its new products recently released while it continues to bleed market share to AMD. Obviously, Intel missed out on the whole AI revolution. They're kind of old school. And they bring this back. They're still building these billion-dollar fabrication plants. That's a lot of money to put into the business. Can they find a way? And there was a really, really good business breakdown in Intel that showed that they may have some hope to get into some of these businesses. Those are the kind of things you're looking for. I'll show you another one on Wednesday just so you can see the breakout. I don't do a rubric on this kind of thing because your boss won't give you a rubric, but there's obvious things you put into an earnings release. So it's pretty just the paper description gives you all of that. So it's very straightforward. Any questions on paper one?
No, I have a question.
Uh-huh.
You want us to provide like any background information on the company or just go straight into the?
It depends on the company. You can certainly put one or two sentences. You should do something to say Lululemon is a leading provider of sports, focused mainly on the women's market, but expanding to men and children, you know, something like that. So you have some sense of what's going on. You don't want 2 pages or 3 pages on that. All right, sorry, I didn't have time to update this. Let's see. All right, we're doing, or any other questions? Paper one, paper two. So we're doing returns. So let's practice a little bit more on this. It's the 25th, but we'll go ahead and pretend like March is over. So let's do, I forgot what stock we did last time.
Yeah, it should be like Costco one.
I didn't even put the name of the stock in here. That looks like it could be NVIDIA, maybe. Let's do Lululemon because I just mentioned it. I've never bought a product from Lululemon, but I know what they sell. So if we're going to do Lululemon, we want to do January, February, and March. So you have to have the ending market value, the beginning market value, and then any income. And we may not have any income here, but we'll still look. So the ending market value we're going to do as of today. What's the difference between the close and the adjusted close? So the adjusted close, what Yahoo Finance does is it adjusts for dividends. Because when a firm pays a $2 dividend, their stock falls $2, but you didn't lose $2 because you're going to get $2 in dividends. So what they do is they take that $2 and they just assume you bought some stock with it. So if you go back in time, if they do pay a dividend, I don't know if Lululemon pays any dividends, so they may not. That's kind of that. We'll do one other stock after them. But if they pay a dividend, you'll notice that the adjusted price is lower than the actual price as you go back in history. So they're essentially adjusting that so that it doesn't look like you lost money just because they paid a dividend. I might show you one stock. It's been several years, but Choice Hotels, we had it in our portfolio and the stock price fell 25%. I was like, what happened? Did they have some negative earnings report or something? That's a large stock drop. Went back and looked, they actually paid a $10 dividend. A $25 stock paid a $10 dividend. Their stock price fell, but you're going to get $10. So yeah, the stock price falls $10, but you can get $10 in dividends. It's a wash. It doesn't matter. So it can be really material for some companies. But what's their ending market value? So here it doesn't matter if you don't pay dividends. The 2 columns are the same. But 388.90. Oops, that's the ending market value for March. The ending market value for February is 467.09. 0.9, did I say? I can't remember. Was it 09? I can't remember. 09, sorry. So 467.09. That's the beginning market value for March. It's the ending market value for February. The beginning market value for February is going to be January 31st, 553.82. I already forgot what I said. I probably even said it wrong. It's hard to type while you're listening, where people are staring at you. And then that's the beginning market value. I mean, that's the ending market value for January. And then the beginning market, what date I'm looking for here? Which date? The beginning market value for January is going to be what? End of December, 5/11/29. So how does it look? Doesn't look very good, does it? So what is the income? They don't pay any dividends, so that's just going to be zero. And so the return, the holding period return, HPR, holding period return. Here we're going to do monthly. Monthly is pretty common, but you can do monthly, weekly, daily, quarterly. It just depends. For real estate, they do quarterly. So the holding period return is going to be any market value minus beginning market value plus accrued income divided by beginning market value. Here, since they don't pay dividends, there was no income to handle. And so we're just going to do any market value minus beginning market value plus income divided by beginning market value. Oh, divided by beginning market value. Any of y'all own Lulu? Hopefully not. Are you going to buy it now? It's a great firm, isn't it? It's got a good product, has a really good customer base. They're expanding to men and to children. There's a lot of things going on, but the stock market doesn't like that.
I think like an A this one, does that mean it's actually losing?
Yeah, they started at $511 and it ended up at $388. So yeah, you lost quite a bit. Yeah, that's a negative return. So you lost 11% in January, you made 3% in February, woohoo, and then you lost 17% in March. Okay. And then we're going to do the arithmetic average. That one's pretty straightforward. Arithmetic is just the average. You're just going to take the numbers and add them together, minus 0.11 plus 0.03 minus 0.17 divided by 3. You just add up the 3 returns. Make sure you do everything in decimals. Don't do 11, 3, and 17. Do 0.11, 0.03, 0.17, and have the negative sign there. So on average, monthly average, you lost 8%. And then when you annualize, so when you annualize, you do the average times 12 because there's 12 months in the year. Oops. Wow, that's interesting. It's exactly 100%. So yeah, if they keep doing what they're doing, you'll essentially not have any stock at the end of the year.
They won't have what at the end of the year?
Your stock would be worthless.
Oh,
Yeah, we'll talk about annualized a little bit more. And then geometric average. This one's a little more complicated, but it's the one you're probably going to use the most. So you need to take $1 and ask what would that be at the end of January. That dollar is going to fall from $1 to 89 cents. And then you take that 89 cents and you invest it in February. Well, what will it be worth at the end of February? So you lost 11 cents in January, but then you make 3% back. But you don't make 3% on a dollar, do you? You make 3% on what? The 89 cents, right? You started with $1, you lost 11 cents. Now you're going to make 3%, but on 89 cents, not on a dollar. So that really hurts you, right? That fall by 11% really hurts you. If you fall 11%, what do you have to make to be back to 1? You can't lose 11% and make 11%. You don't get back to where you started, right? Because you lost 11% on a dollar, but you only make 11% on the 89 cents. So 3% is not going to get you far. And then the next month, so whatever that was, now your dollar's worth 91 cents. And then the next month, that 91 cents loses 17%. So your dollar is now 76 cents. You started with $1, now you have 76 cents. But we're asking for the monthly average. What's the monthly average going to be? Well, you're going to take 1 divided by how many months you have. How many months do we have? 3 minus 1. And you know this number must be lower than that number. It has to be, mathematically. And it was in this case. The geometric is always lower than the arithmetic on the monthly average, always. And then annualize. So you take monthly, it's 1 plus month 1, 1 plus month 2, plus month 3, all of that divided by 1 divided by 3 minus 1. And then you do the exact same thing again, except for one change. Anybody remember the one change? How do you go from monthly to annual? Someone say it loud. It's confidence. Don't multiply by 12, but what do you do with this 1? That becomes 12. If we're doing weekly, what would we do? 52 over 3. All right. So how many periods are there in the year? So you can annualize 3 months. You got to do it to the 12 over 3. This number can be much, much different. So this number doesn't have to be lower than the arithmetic. So when you annualize the numbers, the geometric can be all over the place versus annual. But when you're looking at the monthly average, the geometric must be a lower number than the arithmetic. Mathematically, it has to be. I'll show you why here in a second. I might have done it last class. I can't remember, but we'll do it again because it's good to understand.
How long we do? We're getting 8.35 instead of 3.3. So that's making that annualized.
Well, I didn't use a function. If I use the average function, it probably will be 3.5. I did it the way you're going to do in an exam, right? Is keying the numbers. And if I'd gone out an extra decimal place, I probably wouldn't have had. I don't count off for rounding on exam, so it doesn't matter. So an exam. I wish we could do the exams in Excel because we wouldn't do 3 months. We'd be doing like 400 months if we had Excel, but because you have to do it by hand, I can only give you 3 months. All right. So why is the geometric always lower than arithmetic? The geometric should equal the arithmetic minus half the square of the standard deviation. You want to know why is geometric lower than arithmetic? It has to do with risk. It has to do with exactly what I talk about. When you lose 11%, you have to make more than 11% to get back to where you were. And that's what risk causes that difference. But let's look at it. If I did this before, sorry, we'll do it again. I think I did it. We may have done this, right? Before. We'll do it again because we did, I think, really fast at end of class. So your uncle gives you $100,000. And they say, hey, you're taking an investment class UTSA, invest some money for me. So in the first month, your portfolio falls to 50,000. And the next month, it goes to 75,000. So let's do the holding period return. So in the first month, your ending market value is 50,000. Your beginning market value was 100,000. So in the first month, you lost 50%. The second month, your ending value was 75,000. Your beginning value was 50,000 divided by beginning value. So you lost 50% and you made 50%. What is your arithmetic? Your arithmetic average is minus 0.5 plus 0.5 divided by 2, 0%. Right, y'all remember this from last class? We did really fast, I believe. So your uncle gave you $100,000. After 2 months, he now has $75,000. You call him up and say, hey, you made 0% for 2 months on average. And what does he tell you? If you started with 100 and ended up with 75 and someone told you you made 0%, what would you think? That wouldn't seem very believable, would it? What's your geometric average?
So the HPR here is the $100,000 that your uncle gave you.
That's your beginning market value, right? Here's your market values. You started with 100, ended with 50, so 50 minus 100 divided by 100, right? That's that formula. Ending market value minus beginning market value divided by beginning. So 50,000 minus 100,000 divided by 100,000. Here, your ending market value is 75,000 minus 50,000 divided by 50,000, you made 50%. So what's your geometric average? So your geometric average is going to be 1 plus 50% times 1 plus, negative 50% and positive. We have 2 months. So there your return, average monthly return was negative 13%. Which of those numbers make more sense to your uncle? Do you make an average return of 0%, or do you make an average return of negative 13%? Which sounds more negative 13. That makes a lot more sense. Does that mean this is a useless number and this is the better number? It all depends on what you're doing. There are times when the arithmetic average is the number you want to use, and there are times where the geometric average is the one you want to use. I use the geometric average when I want to know my actual historic return. In the spreadsheet I built, it has my portfolio in it. I do the geometric average. It's actually a dollar weighted geometric average. So it tells me exactly what my return is. It makes a lot of sense. Now, Diego's taking my risk management class. If you're doing an efficient frontier with expected returns, you'll use the arithmetic average. You don't use the geometric average there. So any kind of forecast, use arithmetic. The arithmetic is actually your best forecast for the next month. If someone says, what's your forecast for March or the next month? You would say 0% is my forecast for this portfolio, assuming we had good data. That's only 2 months. But your arithmetic is your best forecast for the next month. So I like to think of arithmetic as your expectations for the future. Your geometric is how you actually did. Okay. But on the exam, we'll do them both.
Oh, now it's doing research with it. I read that geometry is really like compounding.
Yeah, that's essentially what we're doing. We're compounding. Here's a good way to think about it, Jalen. So let's say you started with $100,000, and in the first month, you lost 13.4%. I don't know why it's telling me that. Oh. So the first month you lost 13%. In the second month, you lost 13%. What do you think that ending portfolio is going to be? You lost exactly 13.4%. What do you think my ending portfolio? Any guesses? You should be able to guess it pretty easily because it's sitting up there. What do you think it's going to be? 75,000. So you could lose 50% or make 50%, or you could have lost exactly 13.4. Either way, you end up with 75,000 bucks. That's what the geometric is telling you, is what rate did you need so you hit that ending number? What did you call it in your business corporate finance class? When you're doing net present value, what did you call it? Internal rate of return. It's that same concept. It's that rate that gets you from your beginning number to your ending number. Doesn't that feel more like your true return? That's what you actually really did. So yeah, geometric is what I use in my spreadsheet. Now there are more returns out there. We can't get into all of them. There's also time weighted. There's dollar weighted. It gets quite complex. The CFA Institute has all kinds of rules on calculating performance returns. For the CFA exam, they had just published the rules. It's the longest mnemonic I've ever created. It was 60-something letters long. I memorized that entire thing for all 3 exams because there's so many rules. They never asked a single question about it. If they just said, summarize the performance standards for CFA, I could have written the dissertation, but they never asked the question. But 60-something letters long, I can't remember all the rules. It gets quite complicated. Difference between dollar weighted and time weighted is what the industry says is we don't want to be harmed because you decided to give us $50,000 on the worst possible day. So you give us 50,000 to invest, and the next day the market drops 20%. Well, that's your fault. You shouldn't have given us 50,000 a day for the market drop. So what time weighted does, it's the return, but it ignores the timing of cash flows when you invest it. Dollar weight puts the timing of cash flow in there, which is your true return, where dollar weighted is your true return. That's what you care about. But why doesn't your portfolio manager want dollar weighted? Because you're deciding when to invest money and they don't want to be hurt. So time weighted takes that out. What does the industry advertise? They advertise time weighted. What's the difference between time weighted and dollar weighted? You'd be shocked. Jack Bogle, he published it in his book. He said the return here was 40%. Return there was 0%. The industry advertises that they made 40% when their clients actually made 0%. And why did their clients do so badly? Because their clients were chasing markets. They put a lot of money in growth stocks right before they crashed. They put a lot of money in value stocks right before they crashed. And the industry said, hey, that's not our fault. You invested at the worst possible time. I disagree with that. I do think it's the industry's fault. And why do I think it's the industry's fault? Because the industry markets whatever is done well so they can sell it. So they actually encourage people to buy high and sell low. So I think the industry is at fault. But there's a huge difference in these numbers. So the CFA Institute gives you all the rules about how to report performance. One thing you have to do on the exam, though, is right here on the annualized, you've got to put a footnote on your exam question. And the footnote's going to say CFA Institute does not allow annualizing periods less than 1 year. So you're not allowed to do this. Why are we doing it on exam? Because you don't have enough time to do 50 months or whatever. We can only do 3. I want you to annualize it so you see how to annualize it, but in reality, you're not allowed to do that. All right, so you put that footnote in there, and you can see it gives you crazy numbers, right? Just because you lost on average 8%, you can't really assume you lose on average 8% for the next 9 months, so you'd really be in a lot of trouble. All right, let's do a little bit more of this, but let's make it a little more interesting.
You go back to that really quick.
Oh, the picture of the comp. I think it's in the class notes. I don't know how much of that mnemonic I remember. It would probably come back to me if I saw it, but there are a lot of rules. I've been helping this charity here in town, a former student, and they went out with a request for proposal for firms to manage their portfolio, and only one of them was a CFA firm that actually provided returns according to these rules. The others were advisory firms, and they didn't have any historical data. They could not. Essentially, I mean, you won't believe this, but it's true. She went out there like 13 firms. Only one of them gave her numbers. The other 12 said, hire us without any evidence. We know what we're doing. That's essentially what the industry says. Hire us. We can't tell you how we've done. We don't know if any of our decisions were right, but hire us anyway. Would you hire a firm like that? Does that make sense to you? You don't know if they've ever done a good job. And the scary thing is, it's not that they didn't want to tell her how they did. It's that they themselves didn't know. They didn't have the data. They don't know if their recommendations actually added value or not, but they want her to give them money. The one firm that was a CFA firm had monthly data back for several years. We could actually look at their data and see how they did versus the market. You could actually get some indication. So that's the big difference between a CFA firm and an investment advisor. Investment advisors are not dictated by the CFA Institute. So they have no incentive to tell you how they've actually done. It's kind of scary. My recommendation to the board, I haven't met with the board yet. My recommendation is if they can't give you evidence, they know what they're doing, then I wouldn't hire them. Why would you hire a firm if you just purely on trust? All right, so let's look at a firm. Let's try. Well, I don't want to get too wild. But we'll get, let's try ADM. Why not? So what is ADM? Not ADM, I'm sorry, AMD. So how's AMD doing the last few months? An AI chip maker, how would you think? Probably pretty decently. Let's do historical prices. Let's go back 5 years. Do they pay dividends? We can see real quickly if they pay dividends. Don't pay dividends, so there's no income. We don't have to do the income. And so that what that means is the close and the adjusted close is going to be exactly the same. Right? I'm going to download this. You're going to be doing this for paper 3, so it's good to get this practice here. So we don't need the adjusted close. When you're doing this for paper 3, you will use the adjusted close. So just be aware of that. You'll see why when we do the practice. So all we need is a close. Oh, I'm going to do it again because I don't want daily. What do I want? Monthly. So let's try it all over again. Now, what else could they do besides dividends? They could do stock buybacks. Those are not going to be reflected anywhere. So that's just, that helps their earnings per share, but that's ignored. So a stock buyback is not really income to the investor. It's just, they're just going out and buying their stock. So a dividend would be in there. A stock split would be in there. Y'all know what a stock split is, right? They just cut their stock price in half and double the number of shares. That will be adjusted in here. You do have to be careful. Sometimes Yahoo Finance gets it wrong. So if you see your stock, if it does a stock split, they should adjust all the previous prices. But if you see a stock drop 50%, that means Yahoo Finance missed that stock split. Mostly, usually. I mean, it's possible a stock would fall 50% in one day, but it's pretty unusual. So I'm always kind of I want to make sure. So I might do a quick line chart. Just make sure there's not one line that's just off the chart to make sure there's not an error like that because they can make errors. Usually with monthly data, that's not an issue, but with daily data, you can have that issue. But that looks pretty good, doesn't it? You can see when AI took off, right? Definitely helped the stock price. So let's do a holding period return. Can we do a holding period return for April? No, because we don't have we don't have the beginning market values. So what's the return for May? So I don't quite have 5 years here, but we have almost 5 years. So the ending market value is 27.41. The previous market value, the beginning market value is 27.63. So they fell slightly. Now I want to copy this down. How do I copy it down? How do you give me a heart attack? Right? You never do that. So y'all know how to copy it down. Someone tell me. Double click where? Right corner. All right. How many? If you're still dragging with the mouse, you're doing something wrong. How do you know you're using Excel correctly? Never touch the mouse. That's how you know. All right. You can do that. How do you do if you go on a cross?
Just make control and left. Make control shift left.
Well, let's say I want to do. If you do control shift to the right, it's going to go all the way to the end. Did you want that? Here's how I do it. Y'all might know it better. I just go to the end. I put a 1 there. I come back, control right, and then I've got it. So that's the way I do it. But if someone's got a better way of doing it, that can work. Y'all see what I did it? So I do control right. What's control right gonna do? Take me to the end. I put a 1 there. Why do I put a 1 there? So it knows where to stop. Control left, control C. I've got it. So that's the way I do. Anybody got a better way of doing it? And how long does it take to do that? Let's try it. So. It's still pretty fast, isn't it? It's not quite as fast, but you can see it's better to put stuff down the page than across the page because of that reason. So, all right. So there's my holding period returns. Now I want to do an arithmetic. So how do I do that? Equal average. The equal average function in Excel is the arithmetic average. All right. I must be boring y'all to death. I see somebody's iPhone's going right now. All right. So there's my monthly average. Is that a pretty high monthly average? That's a pretty radically high monthly average. So 12% return would be a 1% monthly average for an annual. So that's, they must be doing pretty really well. Then you annualize that. It's just going to be that times 12. That's a pretty radical annualized number. Do we need a footnote here?
No,
Footnote, because it's more than a year's worth of data. Now the geometric link, I had a student show me how to do it in Excel, but I can't get it to work. There supposedly is a function. Here's how I do it. I start with $1 and I just take that dollar times 1 plus this return. So at the end of the first month, I have 99 cents. The next month I make 10%. So I'm up to $1.10. The next month I make a few pennies. Next month I make 3%. So I just keep doing this. So if you started with $1, how much would you have at the end of the period of time? You'd have $6.50. So what is the geometric average? It's just going to be that linked raised to the 1 divided by how many months do we have? Is it 59, I think, because let's do 59 months. So there's my geometric linked. Does that look like it could be correct? It has to be what? Lower than the arithmetic, and it is. But let's test it. What do we say it should be? It should be the arithmetic average minus 0.5 times standard deviation squared. Let's do the standard deviation. So let's see if we even get close. So the arithmetic minus 0.5 times the standard deviation squared. Pretty close, isn't it? So the geometric is going to be the arithmetic average minus half of the volatility or half the standard deviation squared. It won't be exactly the same, and why not? Because this formula assumes what? That it's a perfectly normal distribution that y'all learn in your SAS class. Is it possible ADM, AMD is the returns are not perfectly normally distributed, that there may be some skewing going on? It looks like there was a little bit of skewing, but it's pretty close, right? 3.22 versus 3.17. So why is the geometric lower than arithmetic? It all has to do with how volatile the stock is. More volatile stocks have much higher arithmetic than geometric. If you don't have much volatility, it'll be almost exactly the same. All right.
so can you click on C3 for
See what?
C3?
Yeah, it's just ending market value minus beginning market value divided by beginning market value. You'll do this a lot in your career. I wish I knew how many times I've done this. I mean, it's got to be in the millions of times because you're doing thousands of stocks and you're doing this a million times. I mean, it's just a very common approach. Now, how do we annualize? So here it's the same thing. It's going to be that 650 raised to, but not 1 over 59, but what? What I'll raise it to for annualized? 12 over 59 minus 1. So the annualized geometric average is 46.34%. One thing I love to do, because I think it's just really powerful, is I'm going to take this $1, I'm going to grow it by the geometric average. And the last number is going to be what? It's going to be $6.50. What I like to do is I like to graph those two things because it gives me a really good idea of what the stock price has done. So it went from $1 to 6. If you had bought it for $1, you would have 650 today. Was it a straight line up? No, it did great. Then it lost a lot of money, and then you have the AI revolution. But that gives me a good picture of what the stock history has been in the last few years. To me, it's just a tremendously valuable analysis. You see that this AI is a pretty recent thing for them. And this firm was really struggling there for a while. You know, you look at some of the histories, it's amazing what AI has done with some of these stocks that just really turned them around the whole story. So when you contrast, and you don't have to just do this with stock returns, you can do it with revenue, with earnings. What you're looking for is, yeah, they're up dramatically, but what was the history of this? What happened here? Why did they sell off so much? We know what happened here. That looks like a pretty big day, doesn't it? This last month, they're down 6%. Is that because they got new news or because the stock just got overvalued? What's going on with the stock? So it gives you some really interesting insights with the firm. But that's the arithmetic and the geometric. Let's try one more stock just so we can get a little bit of practice here. And I'll do a stock that pays dividends. Let's try Duke. So what is Duke? Duke Energy. Anybody know Duke Energy? Any of y'all East Coast people? Yeah. So utilities. What do utilities do when it comes to dividends? They pay huge dividends, right? $1 dividend, $4 dividend for a $94 stock. That's like a 4% yield. So they pay huge dividends. Let's go back a little bit further than, well, I can't. 5 years. Let's go back to 02/28, 2019. Hopefully that gave us the data, but we'll see. So I'll bring this in. Now you're going to notice the dividend. Well, I definitely noticed the dividend. Let's get rid of everything but the close and the adjusted close. Look at that difference. The stock price was actually $91.12 5 years ago. But if you adjust for all the dividends they paid, it was really only $74.11. The adjusted close is going to give you the true return for this stock, not the $91.12. If you do the $91.12, you're going to understate the return because you're going to assume they paid dividends, but you didn't get it. You own the stock and they paid a dividend, but you didn't get the dividend. That doesn't make sense. So you want that dividend in there. Now you notice we're not going to have dividend in the formula because the dividend was adjusted in the stock price. So Yahoo Finance did it for us. So when we do the holding period return, so plus plus that minus that divided by that. So ending market value minus beginning market value divided by beginning market value. So they had a horrible month back then. When do utility stocks fall when it comes to interest rates? Do they like higher interest rates or they like lower interest rates? High dividend paying stocks. They like low interest rates. Why? Because they're viewed as bond substitutes. They have duration. You could say utility stocks have a positive duration because most people like to buy them as a bond substitute. They're real stable firms. They're real predictable. They have a monopoly. They're protected by the government. If their costs go up, they just raise their rates. And the government lets them do it. Very, very safe companies that pay high dividends. They're kind of a bond substitute. So interest rates rise, they do not so well. And so you're probably going to see this firm with a lot of negative numbers when interest rates are rising. All right. So the arithmetic average is 0.58%. You notice the stock started at 91.12 and ended at 94. That looks pretty pathetic, but when you adjust for the dividends, it has to have a fairly decent return, 0.58%. I don't think I've ever spelled the word arithmetic correctly. So annualized, we just take the arithmetic times 12, real straightforward. Not a great return, but it's a very, very safe stock. We'll talk about beta later. This is a very low beta stock, very safe stock, very defensive stock. So you expect a lower return because it's pretty low risk. And then the geometric, say, what if I had $1 today, I invested it and lost 6% first month, I'd only have 93 left. And at the very end, I would have had $1.28. That's not all that great, is it? But that's over 5 years. We take that and raise it to the, I got to know how many months there are. In 59 months. But you take that geometric length number and raise it to the 1 divided by 59. So if you raise it to however many months there are, 50 months, 500 months, 10,000 months, whatever it is, or if you're doing daily, you just, however many there are, you just raise it to that power, all right? So 1 over 59. So that's pretty straightforward. Now be real careful. It's not the number of months of data you have, because we actually have 60 months of data. But one of that pieces of that is our beginning market value.
Right.
We only have 59 returns. So it's not the number of months, it's the number of returns, right? So subtract 1, it better be lower than what? Better be lower than 0.58%, and sure enough it is. And then to annualize that, same thing again, the 128 raised to, but here 12 divided by 59 minus 1. And that gives us 5.09%. And I can't spell annualize either. And we could test it again and see. So the standard deviation here, $566. What was it for the other stock? 15%. A pretty big difference in standard deviation, isn't it? Who knows how to annualize standard deviation? You takers on that? What did you learn in your stats class? Can I take that times 12? The answer is no. So what's the right answer? If I told you you can annualize volatility, but you can't annualize standard deviation, and volatility is standard deviation squared. So if I got the volatility, I can multiply that by 12 and get the annualized volatility. But how do I annualize standard deviation? Any takers on that? So I can't multiply by 12. I have to multiply it by what? Not 1 over 12. Square root of 12, exactly. So annualized standard deviation is the monthly times 12 to the 0.5 power. If I'm doing weekly, what would I do? I multiply by 52, the square root of 52. All right. So standard deviation, what you can do is make it volatility. Multiply that by 12. And then take this, the square root of that. Can do that. All right. These are stuff that they should have taught in your stats class, hopefully. When did y'all have stats? Was it like 3 years ago or something?
I don't think they really teach stats also to help us with how it relates to.
Yeah, sometimes they teach it from the math department standpoint, which is not really what you need. It's still a really, really important class. All right, so we'll see if the geometric average equals the arithmetic minus 0.5 times the standard deviation squared. And how close is it? That's pretty close. Can I give you some argument that Duke Energy's stock returns are fairly normally distributed? If that formula gives you a close number, then you know it's probably a normal distribution of returns. Really, really powerful stuff. There's a lot we can do with all of this type of analysis. We'll do more of it when we do beta, because beta is going to look real similar to this. But that's what returns are all about. It is much more complicated than this. If you look at modified Dietz, if you look at the formula, it looks a lot more complicated than what we did. We did ending market value minus beginning market value plus income over beginning market value. But you notice with them, they don't use, so B is the ending market value, that's the same. A is the beginning market value, that's the same. So that's the same. A is the beginning market value, that's the same. So what do you notice? This F and this F weighted, what they're doing is they're taking, the F doesn't mean income, it means cash flows, which includes income. So dividends, purchases, sales, what you have to do is you got to put those cash flows in them, and then you have to weight them for time. So this is a time-weighted, modified Dietz is a time-weighted return. What they're trying to do is take out the impact of when you time your cash flows so it doesn't impact your return. It looks complicated. It's not as bad as it looks, but it does this right here. What that means is every single cash flow you have to have the date for it. Every purchase, every sell. So we used to do this in investment society with our portfolio. If you got a dividend, it's not the X date, it's the actual payment date. What date did the dividend pay? You have to capture that date in your Excel spreadsheet. If you bought the stock on April 4th, you have to put April 4th in there. If you sold some of it on April 20th. So that's what modified Dietz does, is trying to take out the impact of the timing of that cash flow. This is what CFA Institute requires. So we're doing a much simpler formula. But if there's no cash flows, it doesn't really matter, because all of this essentially kind of disappears. If there's no cash flow, we know if there's a dividend, there is a cash flow. So anytime there's a dividend, you'll get a difference between our holding period return and modified Dietz, but it's the same type of thing. So time weighted return and internal rate of return, essentially what they're saying is one ignores the timing of cash flow, one includes the timing of cash flow. So internal rate of return is a much more accurate return figure, but it's impacted by when you decide to give the cash flow. So you can look at all these formulas. It gets really, really, really complicated. You have to collect a lot more data. So most firms have some software package that collects all of that, or their custodial bank does all that for them and gives them all the data. So there's someone collecting all the information for you. And you have to keep track of it. It can get quite messy. And that's part of the problem with using Yahoo Finance, because this dividend date here is X dividend date. That's not the payment date. That's the date. That's the month you want the dividend in. But for modified Dietz, you actually ignore that. And what you do, I mean, you're going to accrue it as part of your income, but you ignore it because the date you want for modified deeds is when you actually got the dividend. So it gets, you can imagine how massive these spreadsheets get. They're just really, really complicated calculations. So this is X date, but the modified deeds, you need actual payment date. Trying to find a good example. You know, so typically if they pay a dividend, so there's the closing adjusted close. So if they pay a dividend, you would expect the stock price to fall by the dividend. They actually had a good month here. We should go back to daily. You can see a little bit better. Let's find that dividend date. So here they paid $1.25. So you notice that the stock actually went up $1. So they went X date $1 and the stock went up $1, but in reality, the stock really went up $2. As you would expect the stock price to fall $1 when they pay $1 dividend, it actually went up $1. In reality, you made $2. Let me show you another date. Hopefully we'll have a date where it actually falls. Here's $1. No, they're doing really well on our dividend dates. So here's a perfect example. They pay $1 dividend. The stock falls $1. You say, wow, I lost $1. Well, not really, because you're going to get $1 in the mail in a couple, well, probably not in the mail, but you're going to get $1 in a couple of weeks if you own the stock on that day. That means if you sell the stock tomorrow and you lost $1, what's going to happen? You own the stock on X date, you're going to get that dividend. So let's say you bought the stock today for $91.70. You sell it tomorrow for $90.70. You lost $1 on the stock, but in a couple of weeks, you're going to get $1. You broke even. All right. What did the modified deeds do? It did it correctly. It said, really, you're flat on that day. You lost $1 on the stock, but you got the dividend, so you're a wash. That's what the adjusted close is doing. It's the more accurate number for your total return. All right. So I can't remember what I said. The team did I say we're gonna have a team competition this week or I say next week? I can't remember how to look at it. Anybody remember on my email? So if it wasn't this week, it'd be next week. So I'll show you a practice exam question maybe on Wednesday so you can see what it looks like. But it's very straightforward. I give you 3 months of data and you just plug it into those formulas. You plug into arithmetic average, the geometric average, you annualize them. Make sure you put the dividend and the X month, X dividend date month. It's a very straightforward problem. Most students get that correct on the exam.
You post both spreadsheets, one without the adjusted close and one with the adjusted close. Which other one those formulas, all of them.
This formula here, well,
Well, you did one for Duke with the adjusted close and for A and B without. Did you post
Yeah.
both of those?
I'll post a Duke one. The other one is,
Those A and B.
yeah, I could probably do, well, probably even more easily.
But your video, which they go up to 20. We'll see a Friday.
Probably Thursday, yeah.
Yeah.
Well, I get Archer Archer Midland mixed up with, all right. Yeah, get used to Yahoo Finance. They really have some powerful stuff. Bloomberg does it a lot better, but Yahoo Finance does a pretty good job on individual stocks. Where you get into trouble is when you're doing mutual funds, but it does a pretty good job. All right, let's get into the cool stuff here. And that's risk. So there's 4 formulas every finance major knows off the top of their head without looking them up. So if you're looking up standard deviations, you're looking up beta, you got to stop doing that. Do any of y'all know these formulas off the top of your head? Any thinkers on that? You probably didn't do beta in your stats class, did you? But you did do standard deviation, R squared, and correlation. No takers? All right. I'm going to show you real quickly how you can do that. I'm going to bring in, for beta, we need one more thing, don't we? In correlation, we need one more thing. So we need the S&P 500 monthly, 5 years. Let me bring this over to our file. They line up, all right? So there's the S&P 500. Let's do a holding period return for the S&P 500. Pretty straightforward, right? Ending value minus beginning value divided by beginning value. So what are these formulas? Right, they all start with the exact same thing. What's the first step in all three of these, all four of these?
Don't you need variation or something?
If I set xi minus x bar, what is that? What's x bar for your stats class? The average, what's xi? Each one of those months. So what do we need? We need the average. The average for Duke, we already calculated at 0.58%. For the S&P, 1.12%. So how do we get the XI? So Duke lost 6% in that month, but on average, they made 0.58. So the difference there is negative 662. You do that every single time. Same thing with the S&P. You take the S&P's return. Wow, it looks like the whole market was down minus its average. There's a massive amount of finance in that one thing. All four of them start with each month minus its average. In finance, everything related to risk is how far can you get from the average. You can get really far from the average, it's considered high risk. If you can't get far from the average, it's considered low risk. All four of those formulas do that. Now for correlation, you also have to do something else. I don't know how to do right I minus y bar. So for correlation, R squared and beta, you need two data sets. Standard deviation, you only have one data set. So the first thing you do is you take the difference. The second thing you do is you multiply. For standard deviation, you take this and multiply it by itself. Take each one of those different, when you multiply, when you square something, what kind of numbers do you get? Positive numbers or negative numbers? Only positive. All right, that's real key. If you want to understand standard deviation, since it's one of the number one risk tools in finance, standard deviation doesn't care if you're above the average or below the average. It only cares how far you are from the average. And some people don't like that. You can try this with your uncle again. Say, uncle, your average return for this security is 5%. But it's really, really risky because you made 30% this last time. And your uncle's thinking, I on average, I make 5, but I made 30%. Why is that risky? Why is that risky? You can make 30% when your average is 5. What can happen next month? You lose 20% when you expect to make 5, right? So in finance, we don't care whether you're above or below. We only care how far you are. When do you care when it's below only? That's the semi-variance. We don't use semi-variance. We only use this. Here, what do you multiply? You multiply these two things by each other. You multiply the x minus x bar of the first thing times the second thing. So you multiply them by each other. Xi minus x bar times y I minus I bar. Can you get negative numbers there? Absolutely. How do you get a negative number here? Well, if x is generally above its average when y is generally below its average, and x is usually below its average when y is above its average, you're going to get negative numbers. If they're both always above their average at the same time and below their average at the same time, what do you get? You get a positive number. So correlation is not worried about the distance from the mean. Correlation is asking these two things, are they generally above their averages at the same time, or are they off of each other? You take the difference, you multiply. The next thing is very simple. You just take the average of all of that. Really, really straightforward. I don't know what this is called here, but this is called the covariance. Y'all probably heard of covariance in your stats class or remember that, right? It's gonna be a positive number, a negative number. If it's a negative number, they're great diversifiers because one's above average when the other one's below, one's above, so they help offset each other. And the last thing you do here, you just take the square root. And here you divide by the standard deviation times the standard deviation. Here divide the standard deviation x times the standard deviation of y. Here, r squared is real simple. It's just correlation squared. And then beta looks exactly like correlation with one change. If y is the stock market, beta, you only divide by the standard deviations of the market. You don't have the individual stock. Let's see how simple these formulas are, right? They're very, very simple formulas. So if I want to do this for standard deviation, all I got to do is take each one of these and square them. And I just take the average of those. Take the square root. Whoops. Must have hit something wrong. Sorry. Hit a button wrong. And then I just take square root of that. We can see if I made an error, we'll see really quick. That look close? Kind of look in the ballpark. S&P 500 holding period return. That look close? So there's the Excel function, STVEVP for population. which is exactly what we're calculating. That's the same thing as I took the difference, squared the difference, took the average of the difference, and took the square root. Can you everybody repeat that? Anybody got that? Step one, take the difference each piece. Step two, square the difference. Step three, take the average. Step four, square it. Isn't that simple? You should never have to look that formula up. That's a formula you should know off the top of your head. All right. And then the same thing with correlation. And here we got those two numbers, the differences. So for correlation, we just multiply those times each other. We take the average of that. And we take that and divide it by the standard deviation of Duke times the standard deviation of the market. And there's my correlation. Let's see if Bill Gates agrees. Y'all think it's right? How much do you trust your professor? Does that look right? It's pretty close, doesn't it? And then the last one is, that's covariance. The other thing we can do is take covariance, but now we don't divide it by the standard deviation of X times Y. We just divide it by the standard deviation of the market squared. And that gives us the beta. How do you do beta? It's equals slope, stock. Come on, Bill Gates. And the market. I think I got that one right. So I recommend all of y'all do this. Bring in a stock monthly returns and calculate standard deviation, correlation, R squared, and beta entirely with the formulas, not using Bill Gates. All right, that's when you know the formula, because there's so much theory of finance in these numbers. These numbers, and I think the key is that very first number. In finance, we define risk at how far you can get from the average. That's so central to everything we do. And then correlation is how they get from their average versus each other. But we use these a lot. What we're going to focus in on is beta, but on your exam one, question one, you talk about R squared when we're talking about style analysis. Standard deviation we use quite a bit in finance. So we're going to be focusing it on beta here, but I'll stop it there. So here's the question. So we did the template over and over and over again. Some people forgot the template. Probably about 10% of the class just misread the scenario. So I gave you a tough scenario because it wasn't our normal one. But let's see. First of all, you want quality. Is this a recession or a growth scenario? Do y'all remember? Yeah, it's definitely negative. Rates, are they rising or falling? That's the big mistake a lot of people make. Oh, recession, rates must be falling. But you got to read the scenario. What does the scenario say? I mean, I even added an adverb. Interest rates will increase significantly. Does that sound like they're going to rise or fall? All right. So several of y'all said rates are going to fall. Why'd you say that? Because of recession. Do rates always fall in a recession? No, they generally do. When don't they? When inflation's a big issue. So when inflation is happening, but it's not all driven by strong economic growth, yeah, you can have interest rates rising and a recession because the Fed's controlling inflation. Because inflation, like in the 70s, we had inflation not because we had a strong economy, we had inflation because we had an oil market crisis. So that's important. What about inflation? Yeah, it's actually falling. Why? Because the rates are rising. So, you know, it's kind of all related. What about volatility rates? So it's high. And then US dollar. Yeah, if inflation's falling and rates are rising, that is like the best scenario for the dollar, and it's the worst scenario for what?
Commodities and gold.
Gold. Yeah, it's a horrible scenario for gold. Gold would hate that. So. And then developed and emerging, what was the story there?
They're doing it first in the United States.
Developed emergence will slow down much more in the US. All right. So we got everything we need other than anything they said on commodities. All right. So, and then I didn't give you long-term treasuries. I gave you what? Short-term treasuries. So I threw a loop there. So sometimes you know, exam anxiety, you got to actually read what's on the page. Some of you like you're in the exam mode and you're not even looking what's on the page. And I understand that exams are stressful. How do short-term treasuries look now? You have a recession, rates are rising. Would you rather have short-term treasuries or long-term treasuries? Short-term. They look pretty good, right? That eventually, now somebody made a good point. Eventually, you're going to need the flip in the long term because eventually inflation can be fixed. They'll start cutting rates. So you may not get the timing right, but until then, short-term treasuries is a really good place to park money. What about inflation linked? Don't need them. Inflation's falling more than expected. Mortgage backs, rates are volatile. I wouldn't touch mortgage back. What about medium quality? You'd rather have higher quality. What about long term? No, rates are rising. And between the two, which do you prefer? Or when you did the math, this came out to 5 something versus 6. So we don't like medium quality. We don't like long term, but to the extent we're going to buy these, we're going to have a preference to corporates over munis. All right. High yield. Don't like them. Why? Because rates are rising. That's nothing to do with rates because of recession. You don't want high yield. I mean, it's interesting this last year, high yield has a positive return and treasuries are down. So interest rates have risen, but high yield is still done well because they look more like stocks. Do we like large cap? Within stocks, we do. Do we like defensive? Within stocks, we do. Do we like small cap? No. Do we like value? No. Developed? No, for 2 reasons. Strong dollar, weak economies. Emerging? No. Alternatives? You could talk about gold. Somebody else talk about gold. Gold was like an obvious don't do gold in this scenario. You would not want gold in this scenario. But I said real estate's going to be weak, commodities going to be weak. So you got some there. So I'm not saying that because the exam. I'm more saying it because I want to make sure y'all do all the interviews. If you can somehow incorporate this into your just automatic thinking, this problem just gets you to the application side really, really fast. I know it's a bizarre exam. You don't have y'all have another class that does an exam like this? It's a little bizarre, isn't it? I mean, our second exam would be more normal. But it's the way we think in finance. So, all right. On the earnings paper, here's an article on Lululemon. I didn't give you Lululemon. If someone really wants it, you haven't started yet, I can add it. You have to email me. But their earnings came out. Nike came out. I've had Nike in the past. If someone wants Nike, I can add Nike. There's a few others that have come out. But if you look at it, their stock dropped 16%. And they tell you right up, and this is what you're trying to do in the paper. They're telling you right up. Why is that? The decline was attributable to guidance, not to the results. Because they actually beat on results. So that's why it's so interesting. They beat on earnings, they beat on revenues, and the stock fell. Why? Because of what they say going forward. Management's outlook. So it's possible you got to see what is management saying in this. And really what you're trying to figure out is, okay, what are all the numbers, but then what is the stock market reacting to? The stock market may not be reacting to the actual earnings release because there may be something else going on. So the fourth quarter results beat both on earnings and on revenue. And then they gave some example of what that guidance is. So COVID, boy, Lululemon's great. Everybody's exercising all of a sudden. But now people don't want to exercise anymore. They want to go on trips and they want to, they want experiences. That's starting to hurt them. So margins were up. They were looking at earnings per share of $5 and revenue of 3.19 billion. It also topped guidance, management's guidance, but I wouldn't worry about that. You can stick with to what's in the Excel file.
What does that mean?
Well, guidance just means estimates. So when management gives estimates, they call it guidance. Why they call it guidance, I don't know. But yeah, so there's some sense that when management, I mean, it's kind of strange that it says it also top management guidance because most people think management lowballs numbers. But they want to say, hey, we think we'll make $3, knowing they're going to make 3.20 so that the market's surprised. So you're kind of more expecting to beat management than beat Wall Street. They say adjusted EPS. This article, I don't think talks about adjusted versus the reported numbers, but I didn't look at that. It's hard to say. And then essentially this article is, a good 60-70% of what you need in the paper. It's the article saying, hey, here's how the earnings did. Here's how the stock market report reacted. Here's what's going on. So you're essentially just explaining the report. So to give you some example papers from last semester, here's one on Alphabet. So they put in their abstract a discussion of the company. A little bit too much, I think, for the abstract. Earnings, they reported $1.55, which was healthy 7% beat versus the expected reported increase by whopping increased 46% in the same period last year. Now, I've taken out of the Excel the expected last year. Some students would say, last year they reported this and it was expected this last year. No one cares what the expected was last year. All right, so that's why I took it completely out of the Excel file. You don't care about that number. That's old news. So you definitely have to put this number in there. You definitely need this number, and you definitely need this number. You'd probably put that number in there. You don't necessarily need to have that number, but you definitely need to say the dollar amount that they reported, and you need the percentage beats and changes, all right? You notice they use the right words. You beat expected, you increase over the prior. You don't beat the prior. That doesn't make sense in the way we say that. All right, so they've got the three numbers there that I'll be looking for. They reported the revenue. Definitely want to report that number. Now they had an adjustment on revenue. That does happen sometimes, which is really bizarre. Most firms, the adjustments are on earnings, but it's possible. So they beat by 1.6%. And their revenue increased by 11.85. Yeah, I think this is really, really wordy. In the same part of last year, they reported this, meaning that they beat it by 11%. I would just say they beat, and they were 11.8% above last year. I mean, I would say it in like 1/5 as many words, but that's just a bunch. The margin, the reported margin, that was pretty massive increase. So you say the reported margin, how much did they beat by? And then increase by 162 basis points. So you have those numbers in there. You can report the previous number, but you definitely have to show the margin, the beat, and the increase. And then they did net margin the same way. So they just give the numbers. They're in there. It's a little wordier than I think you have to, but it's not bad. So I see some students, they'll take twice as long to say it. Most people after that, they jump into what's going on with the firm. Essentially trying to explain, why did their revenues grow so much? Why are their margins going up or down? You're just trying to explain the numbers before you get into why did the market react. And then you see on the market reaction, they put the charts in that I gave them. You can certainly do that. They have a good quote in there, which is always important. I wouldn't put this chart in there. This chart, I would discuss the numbers. It's not a real pretty chart. So, but you have the numbers. So. What the fuck? I mean, it's kind of interesting. They're down when they had such strong numbers. And then you want some way to get off the stage. So some say, what to expect going forward? What does this mean? Bottom line, what's the most important number? You know, whatever you want to say going here to get you off the stage. But right, there's one. Here's one on Tesla. I could have given y'all Tesla this time, but I didn't. So they start off with description of the company and what they're going to do in this report. I don't know what they mean by the status quo, but anyway, so they reported 66 cents, a 10-20 miss, and down 37%. Obviously, Tesla has been struggling somewhat. I mean, it's interesting. You know, all these laws that we're going to be driving electronic vehicles, people, you know, EV sales have been missing marks, haven't they? Just everywhere. And people are like, are y'all buying EVs? Are you not buying them because they're too expensive, or you just don't trust the range? You know, those kind of things. I've got a plug-in hybrid, which I think is much smarter than EV, because I have 500 miles. I can get it in gasoline, but I haven't bought gas. I buy gas maybe once a year. So, you know, I love it. I think it's a much better idea. I don't know why hybrids just make much more sense to me. One of y'all can talk me out of a hybrid, but you know, I don't have to worry about running out of electricity on the road and try to find some Tesla station. But some other people may be thinking the same thing, that, you know, why buy an EV? But that's definitely an issue. So you could certainly talk about that. Revenue, you give the number, the miss, and the increase. You notice again, miss or beat, increase. That's a pretty weak increase for a firm like Tesla, given what they've been doing here. This is not worded correctly. What should that be? Margin growth. It's not marginal growth. So they had that may be a Bill Gates fixed that for them, and they didn't want them to do it. So you give the actual margin. Their gross margins are terrible, but their net margins are quite good. It's an interesting firm. They call this projections. That's fine. However you want to talk about it. But, you know, obviously this is essentially a one product company. So how much are you going to talk about Tesla versus the EV market overall? Is this a problem that people aren't buying EVs, or is this a problem that people are buying cheaper EVs from China? What exactly is the issue going on here? I don't think China has really gotten into the US market as strong as it could. And then they talk about the stock, talk about competitors. They created a nice little chart. This chart makes more sense than the Bloomberg one I gave you. You know, find some way to show it. So, oh, sorry. Showed his own name. So you know who wrote that one. And that was an accounting major, here's a Nike. So yeah, I mean, that's pretty typical. Who is Nike in the abstract, and what I'm doing in this paper? That's not a bad way to start your paper off. Same kind of thing. Y'all seen over and over again, right? Some good quotes. You talk about EPS, revenue, margin. I don't know if I would say revenue growth. I would just say revenue, but you know, they say revenue growth, margin growth. It kind of implies that margins grew. You don't really know if they grew or not, but margins, a little bit different margin, right? 44%. What was Tesla? 17. Very different businesses, right? And then you do Microsoft, which is like 80%. Yeah, a lot more discussion than I would expect. So just kind of getting in there. And then how did the market react? This is Nike. You know, Nike, I don't know how you have that many pages of discussion on Nike, but somehow you did. But what's the issue with Nike? First, you got the demand. Then you got, because of inflation, you got cost of goods sold, what's happening to cotton prices, rubber prices, those type of things. You got some distribution issues going on with a lot of stuff going around the world, just trying to get things. And we just saw another one yesterday, right, with the Baltimore incident. So you have all these issues. You don't really know how to impact a firm, but you're watching for those. So you see how it's just the same kind of format. That one was a little lengthy on the discussion. Here's a firm called Smart. This is a pretty unknown firm. So this is one you would probably want to do a little bit more discussion about who the firm is if you think it's a smaller company. But again, earnings per share, revenue, really small firm, right? $300 million in revenue. Their revenues are 1/10 the size, or no, 1/1000th the size of Apple's, just their market cap. So it's a really small company. Again, I would just say margin. But what's next? So you have the discussion. I don't know, the titles are a little strange to me sometimes, but some good quotes. The quotes could be from management. The quotes can be from an analyst that you find, from an article you find. So market reaction, they show that chart. Just show this chart, which I don't like, but the stock was down 44%. It's a little tough on a really small company like this for me to give you a competitor. I use Micron. That's a massive company. I just couldn't think of who's a good competitor. So Nike is pretty obvious. You can use, Lululemon or Adidas or whoever, Home Depot or whoever. Most stocks is pretty easy. Some is a little tougher. Facebook, it's tough to say who's the competitor. So, it's kind of tough sometimes. So I did my best. If you don't like the competitor I gave you, go find another competitor and see how they did. You can certainly look that up. They did a what lies ahead. I don't know why they have similar topics. I guess I showed similar papers. I'm probably showing some paper I showed 12 years ago, and whatever titles were in that have kind of made it everybody's paper since. So try to write your own stuff. You're on his, but the format is real similar, right? Earnings per share, revenues, margins, gross and net. What's management saying? What's going on with the economy overall? How did the market react? What's next? Fairly standard format in these type of papers. So a good chance in your first job, someone's going to say, hey, so-and-so's reporting earnings. Can you go look at it and 30 minutes, give me a report. I'm giving you 30 days, but come back and let me know what's going on. So that probably will be my last discussion on paper 2. Any questions on 2? Anybody finished their paper yet? Anyone started their paper yet? Okay, to me, it's a fun paper to write. I like that. I kind of do these papers anyway, just because, I like reading about this. Well, your boss asked you to write about the earnings report. Anytime you do earnings report, you're going to talk earnings, revenue, and margins. Not all firms have gross margins, but all have net margins. So you're going to talk those 3 things, 3 or 4. I think all of y'all have gross and net margins. Then you got to say what. So I prefer we just give the numbers, and then you have a discussion that just talks about why the numbers are what they are. So what you're trying to do there is say, hey, is there something going on with the overall economy, like with Tesla, while EV sales are down around the world? Or is it EV sales are up and Teslas are down? Well, that's pretty bad. Who's taking over their market share? You're trying to figure out what's the dynamics here. What is management saying? What are analysts saying? What are articles saying? All right. So you go through all of that, try to find some good quotes. And given all of that, how did the market react? Is it logical? So wow, Lululemon had looked like a pretty decent report, and they're down 16%. But as you can see above, management was a little bit, what are we going to try to explain those numbers? I like to be the last section is not what next, because you really should have covered that. I prefer, I like a summary that's really short, is what was the most important stuff with what I just said. So the key for Tesla is going to be EV sales. I think that's the most important. I think that's the market's reacting. Whatever you want to say, you could summarize it with, I think the market's really focused on this right now. If you're really bold, you could say the market's really focused on this, but I think that's wrong. They should be focused on this. You know, you could, it depends on what, if you have a strong opinion either way. All right. Any other questions?
For example, you mentioned like the solar division.
I'm sorry.
For example, when you mentioned the solar, like.
Well, if it's material, you have to just see. So if you don't think the stock market reacted to that, then, you know, it just depends. I don't think that's a really big part of their business yet. I know he wants to have this all kind of off the grid kind of thing. I don't think he's doing that as a profitable business, but more as a support. But I don't know. You have to just look and see. I used to think SpaceX was kind of a distraction for him, but it looks like SpaceX is actually doing some pretty good numbers. I don't know how much Tesla and they are related, if there's any cross ownership, but you just got to see. But the articles are going to tell you that, right? If it's important, they're going to put it in the article. So if it's not in the article, it may not be important. Other questions? All right. So let me show you an exam question on return. So this is an exam question for a couple of semesters ago. We did Hormel. So the holding period returns, the arithmetic average, annualized arithmetic average, geometric average, annualized geometric average. You don't have Excel, but I do, so I'm going to do it in Excel because I'm lazy, but you'll have to do it by hand. So you have an ending market value, a beginning market value, and we're doing September, October, November. All right. I gave you the ending market values. I didn't trick you by like giving you November 1st or something like that. So it's pretty obvious. The ending market value for September is 45.44. The beginning market value is 50.28. October is 46.45 in beginning. And then November is 47 and then beginning. So you essentially have 45, 46, 47, 45, 46, 47, and then 45, 46, and then you have to start with the 50. And then we need income. So y'all tell me, well, the income's 26 cents, but what month does it belong in? Wherever the X date is, October. So October has an additional 26 cents. So wherever the X date is, that's the month the income goes into. All right, pretty straightforward. Wish I could do the exam on Excel. If we did it in Excel, if I could somehow find a way to get you to Excel, I wouldn't give you 3 months. I'd probably give you 36 months or something. Be a lot more realistic. And so the holding period return is just going to be any market value minus beginning market value plus income divided by beginning market value. Pretty simple formula. So here for September, we have 45.44 minus 50.28 plus 0 divided by 50.28. Obviously, they lost a bunch there. Here, you have 46.45 minus 45.44 plus 0.26 divided by 45.44. Made a little bit there. And in the last month, 47 minus 46.45 plus 0 divided by 46.45 made 1.18%.
What is the PR?
The holding period return.
What is that?
It's the return for that month. So HPR means you got to pick some period of time. We usually pick a month. You can't pick a week or a day. But here, our holding period is a month. The month is 99% of the time it's going to be monthly. All right, so there's a holding periods. So we got the first thing down. The next thing is do the arithmetic. The arithmetic's very, very straightforward because it's just the average. So all you got to do is add these together. Here's where I would say forget percents, do everything in decimals. So you got minus 0.0963 plus 0.0279 plus 0.0118. How many months do we have? 3 months. And there's the arithmetic and annualized. How do we annualize arithmetic? Did you say divide or multiply? Multiply by 12. And then we have to put a little asterisk there. What's the asterisk gonna say? I don't know how many typos are in there. I don't think that's how you spell annualizing, but. All right, so I'm asking you to do something you're not allowed to do, but you're gonna do it just so you can do it. You can see why I'd love to do 36 months, so we don't have to put, this is kind of a really useless annualized number because it's just only 3 months. All right, and then geometric. Here, you got a lot more calculations. You got 1 minus 0.0963 is how much $1 make you that first month. And then after you have that, then you got to invest that whatever's left for the second month. And then whatever you have there, you're going to invest for the third month. And then you're going to take it to 1 divided, how many months you have? 3 minus 1. And you better get a number less than what? It'd be negative 1.5 or negative 2.2, which would be possible. Or is it negative 1.8 or negative 2, which is more likely? Negative 2 would be more likely, right? It has to be lower than the arithmetic. Does that work? So it is lower, so that gives us some confidence. We know if it's higher, we did something wrong. It's easy to do something wrong with all those calculations, but you see how I took that 963 and converted it to 0.0963. There's some finance students, for some reason, had trouble converting between percents and integers, so which is kind of strange. You think they would have that down. And then the annualized here, the nice thing is it's the same formula again. So you might actually want to just do that part. Just do that part of it and then raise the first one to 1 divided by 3 minus 1. And then what do we do here? We don't raise it to 1/3. We raise it to what? 12 thirds minus 1. This one can be anything. It'd be higher, it can be lower. So there's no rule about the geometric versus the arithmetic here, but there is definitely here. That's it. We did everything on the list. So we'll do a team case probably on Monday on this. Get some practice. In fact, the 10 cases from now on is going to be exam 2. We're going to go through every exam 2 question as a team competition. If you do really horribly on a team competition, guess what? We'll do that question again in another team competition. So we'll do it. We'll eventually run out of class days, so hopefully you'll get it eventually here. Any questions on that? Which annualize? Yeah, they're the exact same formulas. The only difference is instead of 12/3 instead of the 1/3. That's the only difference. If I had 36 months there, you would still do it to the 12 over 36. All right. So the numerator is how many months do you have? The denominator is how many periods there are in a year. Okay, everybody see that? So we're doing 12 divided by 3. Why? Because there are 12 months in a year. And we had 3 months of data. All right, so if we had 60 months of data, what would this have been? It wouldn't have been 12 over 3. What would it have been? 12 over 60. All right. So the top number is telling you how many periods. If we're doing weekly, we'd be doing 52. But the bottom number is always going to be however many months you have.
The formula again for arithmetic average.
The arithmetic, we just multiply by 12. So you're
On J9, you need to show us.
J9. Well, arithmetic, you're just adding the 3 numbers and dividing by 3 because you had 3 months. If you had 60 months, you add all 60 months and divide by 60. I mean, in essence, it's the average function. Right?
So, can you go back to the little window that you put up, you used for the example that had the months and all that? Right, okay, so August is there, why are we not including August?
Well, you don't have a beginning market value.
That's, okay,
Yeah, you
so we
can't.
gotta remember that when you give us.
Well, let's see how the question is worded. I can't remember. It says the last 3 months.
Oh, okay.
So, and the exam was given in December.
So when would the 12 ever change? Because what if it was quarterly?
Quarterly, use 4. If it's weekly, use 52.
Is there any situation where like the numerator would change based off the data?
Well, I'm only giving you monthly, so you're always going to be using 12. But if I give you weekly, you have to use 52. It's how many periods are. Now, when it gets tricky, and this is really, really tough, if you do daily, you don't use 365. What most people do is how many business days are there, which is more like 250, but that gets really, really tricky. So yeah, it's hard to annualize daily numbers because it's a tough.
And the exam will be just one question like this.
Well, that's one of the exam questions. Yeah,
Okay.
there are several exam questions, but yeah, it will look a lot like this. You'll see as we go through this, we'll be looking at similar questions. All right. So last class we talked about risk. How many of you remember the formulas? Anybody? They all start with what? Well, flip that, but yeah, xi minus x bar. All of them start with that. All right. Standard, and then the next thing you do is you multiply. So you start off with the difference, all the same. Then you multiply. That's where it's a little bit different. Standard deviation, you multiply what? That difference by itself, right? You square it. All the negative numbers disappear. So remember, standard deviation is really, really important. Standard deviations, the question is not did you make money or lose money, but how far were you from the mean? That's how we define risk. All right. So that's why we square it. Those outliers get really, really pushed up in importance. Because when you square a big number, it dominates squaring a small number. So standard deviations all focus on how far from the mean you can be, and you're squaring it, so you don't care if you're above or below. There is a thing called semivariance, which is essentially the standard deviation, but only when you're below the mean. But standard deviation does both of those. For beta correlation R squared, you have to have 2 sets of numbers. So you have to have an X and a Y. So Xi minus X bar times Yi minus Y bar. There, we're not asking how far from the mean you are. There, on these 3, we're asking when one's above its average, is the other one also above its average or is below its average? We're trying to see, are they moving together, not up and down. We're asking if they move together relative to their averages. Are they both above their averages at the same time, below at the same time, or is there some difference? All right. I mean, it's possible they could both have a positive return, but one's positive return is above its average, the other's positive return is below its average. So you see, it's not whether they're both positive at the same time, it's whether they're above the mean or below the mean. All right. So you take the difference, you multiply, then you do what? The third step's pretty straightforward. Just take the average of all those multiplications. That's real straightforward. So difference, multiply, take the average, and then what do you do with standard deviation? Take the square root. That's pretty straightforward. For beta correlation, the difference, the multiply, and the average is called what? That number called covariance. So beta correlation, you take covariance divided by the standard deviation of X and Y. R squared, you square correlation. Beta, you take the covariance and divide it by the standard deviation of the market squared. All right. So I just think these formulas are really, really simple. They're really not that hard to remember, are they? There's not, and I think the reason they're so easy to remember is because they're so similar, the four of them, and we use them all the time. So you really, really need to make sure you know them. To me, if you don't know these formulas off the just in a nanosecond, it'd be like a pre-med student or a medical doctor having to use an anatomy book to figure out, where the appendix is or something. It just doesn't make sense. This is our appendix. No, this is our anatomy book. These formulas, we just know them because we use them so much. If your only knowledge of this formula is an Excel function, you don't know the formula. All right, so you got to make sure you know these formulas. Those are the four big ones. We'll talk about duration. I'll show you duration when we do bonds. It's another formula you should know. It's a pretty easy formula too. All right, so we talked about that. So when do we use standard deviation? Standard deviation is also known as total risk. So if you're looking at your entire portfolio, you want to use standard deviation. All right, that's the right measure for your entire portfolio, standard deviation. Higher the standard deviation, more risky it's considered to be. The lower the standard deviation, the more stable it is. So if you have all your portfolio in stocks, you're going to have a pretty high standard deviation. If you have your portfolio mainly in bonds, it's going to be much lower. It doesn't care if you're above or below the mean. It just asks how far from the mean can you go. And standard deviation is very sensitive to outliers. So when October 87 happened, the market was down 23% in one day. Daily standard deviation skyrocketed. Because that one number, when you square that massive number, it just takes over everything. And so people had asked the question, well, did we leave October 87 in our numbers, or we take it out? Is it skewing our numbers too much that we can't trust them? So you have to ask those questions. But so for individual stocks, standard deviation is not the right measure of risk.
Well, when you're talking about those outliers and you're having that discussion, like, is that like the industry type consensus, or is it like by firms or?
Well, you're looking at history to do your future.
Right.
If you got one really strange period, you're like, and say, well, man, October 87 is really, really strange. When we're trying to project standard deviation going forward, we'll just leave that out because that was such a strange period. Now, some people argue, well, but it could happen again. That's a pretty big day. Now, in 2008, we had some 10, 11% days, but we didn't have any 23% days. It's just because you're squaring it, that one day can have a massive impact on your assumptions. So you have to be careful. You can argue whether you keep it in or leave it out, but you have to make a decision. But individual stocks, standard deviation is not the right measure of risk because stocks are not perfectly correlated. So you have a stock with a high standard deviation, but it might do really well during a recession and do not so well in a strong economy. So its standard deviation actually helps you. You want it to have a lot of standard deviation. If it's going to do well in a crisis, you hope it's up 80% because this can help offset risk from somebody else. So standard deviation is not the right measure. And this is where William Sharpe came around. William Sharpe came up with the capital asset pricing model, CAPM. So as far as we know, it's the most referenced theory in finance. Someone did a study once of whose PhD paper is the most referenced in the history of finance. They gave up after several thousand references and just say he's in first place. His paper that he wrote back in 1960 something is the most referenced paper. So he's got that, and he's still around. He's still working. He has a website where he gives out free stuff if you want to, use some of his models. But he came up with CAPM. He developed CAPM after Markowitz. So Markowitz was in the 50s. Markowitz passed away last year or 2 years ago. No, it was last year. And if you read Peter Bernstein's Capital Ideas, he goes through that history. Why did Markowitz have to come before Sharpe? I liked how Bernstein does it. He teaches finance chronologically. makes a lot of sense to me. I really highly recommend Capital Ideas. Because in finance, we don't teach it chronologically, we just throw it at you, but you can see why we had to have this first, and then this built on this, and then this built on this. It gives you, I think, a better understanding of the theories we're looking at. So why did Sharpe have to follow Markowitz? Well, because Sharpe was trying to find a simplified version of Markowitz's efficient frontier. So if you think, yeah, I mean, boy, we could get into this. It's just so interesting to me. So, so Markowitz was looking at the correlation of stock A to stock B, stock A to stock C, stock A to stock D, stock B to stock C. I mean, you have 500 companies, you got a bunch of correlations you got to do. I don't know how they did it in the 50s because they didn't have calculators. I don't even know how you do it on a slide rule. That would be a lot of calculations, wouldn't it? Figure out how Apple's correlated to all 499 other stocks, and you got to do the next stock, thousands and thousands of thousands of calculations. William Sharpe comes in and says, you don't need to do that. You just have to look at Apple's correlation to the market. You just have to look at Google's correlation to the market. You don't have to do them all the other stocks. Great simplification, right? What award did he win for coming up with that? Anybody know? Nobel Prize in Economics. Markowitz also won that. So, yeah, I mean, it's very simple. That's one thing I love about Sharpe's model is it's so simple. I love simple models that explain a lot. It's a really great model. And so what he was saying is you don't need to look at the stock's individual risk or its correlation to other stocks. The key is how does the stock move versus the market? Is it a diversifying stock or is it a risk increasing stock? A diversifying stock does really well in recession, maybe does kind of mediocre in a strong economy. A risk increasing stock is one that just nosedives in a recession, but does great. So he's saying you look at those and that's what you're interested in. So he says total risk, standard deviation can be broken between systematic risk and unsystematic risk. Systematic risk is how that stock's related to the economy. Is it, well, what did y'all do on exam one? What kind of stocks did you talk about under beta? Two types of stocks, defensive and cyclical, right? That's what he's talking about. Is your stock cyclical, which has what kind of beta? High beta, or is it defensive with a low beta? That's what he's saying. He's saying that's what matters. All right. This unsystematic risk is not related to the market. It's about the stock. So we're talking in our dashboard this week. We talked about this CEG company that was up 10%. Why was it up 10%? Because someone wrote an article about it, making a lot of money, providing energy to the AI industry. Okay, that's interesting. Another stock, International Paper, was up 11%. Why? They hired a new CEO. All right. Did they hire the new CEO because economic numbers that came out? Was that related to the overall market? They say, hey, you know, the S&P is up 2% today. Let's hire a new CEO. That's probably not it. Completely unrelated to the market. They just hired a new CEO and the stock was up. All right. That would be an unsystematic risk. So he says there's systematic, unsystematic risk. And he said, it's amazing. When you're looking at the risk of a company, you can ignore unsystematic risk. Why? Because once you add 20, 25 stocks, it completely disappears. Once you have a portfolio of 20, 25 stocks, you've completely eliminated your unsystematic risk. So he says, ignore it. What's another word for systematic risk? Non-diversifiable risk. That means you can't eliminate systematic risk by just adding more stocks to your portfolio. That's not going to work. How do you eliminate systematic risk? By adding more low beta stocks to your portfolio. You can't just randomly add stocks to your portfolio to have systematic risk come down. You have to intentionally add low beta stocks to your portfolio.
So like when stocks rally during some Fed meetings, would that necessarily be like systematic risk or
Yeah, if it's something that affects all stocks. So cyclical stocks might rally 2% and defensive might only rally 0.5%. So that's going to explain why their betas are higher or lower. Yeah. All right. So Yeah, so systematic versus unsystematic. Systematic risk is also known as relevant risk, which makes sense because that's what he says is relevant. For you as an investor, how should you be compensated for risk? And he says you should be compensated for taking systematic risk. If you buy higher beta stocks, you should get a higher expected return because you're taking a riskier position. If you buy lower beta stocks, you should get a lower return, but you're happy with that because it's a lower risk company. And he says you should not get any compensation for buying a really, really volatile stock that has a low beta because that unsystematic risk is just going to disappear once you put it in the portfolio. Pretty radical idea and really, really simple. What I love about William Sharp and the way he thinks, if you go back to his paper, is after developing his market, he then asked the question, what would stock markets look like if everybody followed my model? Would they look radically different, which means there's something wrong with my model, or would it explain what's going on in the world? There's been a lot of debates. How do you figure out if this works? Is Sharp beta dead? Beta is back. All right. That's good. I used to be able to say, is beta dead or alive? But the problem is a new thing called beta came along and it thinks I want to do some Xbox or something. Is beta dead or alive? Is beta dead again? Is beta dead or alive? I don't know, I don't know which ones are related to William Sharp. Is beta dead or alive? But before whatever that happened, that was now known as beta, you would get a million articles. Beta's alive, beta's dead, beta doesn't work, beta does work. How do we know if beta works? Well, one test that's really simple is just to go back historically and see if high beta stocks actually have higher returns than low beta stocks. If they do, then the model makes sense. You should get paid a higher return for buying high beta stocks than for buying low beta stocks. And there's a lot of debate on that. Most people say it doesn't quite work very well. In fact, lower beta stocks actually have many periods have higher returns with lower risk. That should not be an efficient market. Market shouldn't let you buy low beta stocks, get a higher return with low risk. So there's debate that's out there, but it's a big part of this debate. So a portfolio has a beta of 1.2 in expected recession. What do you do? So how do you lower your beta? What specifically would you do? You sell the high beta stocks, buy low beta stocks. All right. So systematic risk is your relevant risk. Here's the formula for beta. It's covariance over the standard deviation of the market squared. In Excel, which is what you're going to do for paper 3, you're going to use the actual slope function. Right? You could use this function, covariance of the two ranges over the standard deviation of the market square, but this is a little bit simpler. So you got to be real careful though. Your range 1 has to be your company. Range 2 has to be the market. Don't switch those two here. You get a wrong number. All right. Range 1 is your stock. Range 2 is the market. Otherwise, it doesn't know which standard deviation to divide by and squared. All right. So use the slope function. All right. We'll come back to this. For bonds, what do we use? Well, standard deviation is really risky for bonds because bonds, you can lose 100% on bonds, but what's the most you can make on a bond? Whatever your entry level is, whatever your starting yield was. So bonds paying 6%, if you buy $1,000 bond that's paying 6%, you're going to make 6%, or it's going to go out of business. It's not going to make you're not going to buy a 6% bond and make 32%. It's just not going to happen. So standard deviation is dangerous because standard deviation assumes this nice normal curve, but bonds have downside, but they don't have a lot of upside. So we use duration and convexity. So I'll show you duration. I won't show you convexity, I'll show you duration. It's a really easy number to calculate. I've had some students actually calculate duration on the exam. You don't need to do that. You don't get any points for that, but they just wanted to show off because it is a fairly easy formula. All right, so You have these two risks, systematic, unsystematic risk. Systematic risk is tied to anything that affects all companies in some way. So I use the economy, talking about cyclical and defensive stocks, but there are other things that impact all companies. Inflation, like in 2022, some companies were more impacted by inflation than others, but that was a risk that affects all firms. So we're not asking, does it affect all firms equally, but does it affect all firms? Some firms this affects a whole lot, some a little, but all firms are interested in inflation. Interest rates affect all firms. So some firms like banks, interest rates affect them much more heavily, but all firms are affected. Geopolitical events, a war or some major crisis around the world is going to affect also COVID, the Russian invasion. Those things affect everybody, but they affect some firms more than others. You know, you've seen what's going on with China. That's certainly affecting some firms more, like Apple being affected much more than others, but it does tend to affect all firms. Every stock is exposed to systematic risk, but at different levels. And the real problem with beta is that CAPM is a one-factor model. It says you can take all of these systematic events and summarize them into the stock market. The problem is different firms are hit by different things, and different things are important at different times. So inflation was a big deal of 2021, 2022. Interest rates have been a big deal 2023, 2024. Difference. So those systematic events move around. That's why we're going to look and see why beta is such a unstable number. So this is the actual definition of beta. Beta is not systematic risk. Beta is the measure of the relative systematic risk of a stock. All right. We'll look at the systematic risk of a company here in a little bit when we calculate some numbers. But beta is a measure of relatives. What we mean, we're going to set the stock market's beta at what? At 1. And then we're going to put every company relative to that. The market's at 1. So if your beta is 1.2, you have how much more systematic risk than the average stock? If your beta is 1.2, you have 20% more systematic risk than the average stock. How much more unsystematic risk do you have? We don't know. Beta doesn't tell you that. All right. A stock with a high beta is more cyclical. Stock with a low beta is more defensive. So if Apple has a beta of 1.2, you don't say that Apple's systematic risk is 1.2. You say they have 20% more systematic risk than the average stock. Now, beta is unlimited. If you went out and borrowed $1 billion, borrow $1 billion to buy $1.1 billion worth of put options on the S&P 500, your beta would be like negative several trillion. Who knows? I mean, you can leverage up beta. You can get a massive beta. But for a typical stock, I rarely go below 0.4, and I rarely go above 3. It just seems strange to me. So what might be a 0.4 company? Yeah, Costco, Walmart, maybe a pure grocery store, maybe like a Kroger's. Yeah, those really staples. Utilities can get in that 4.4, 0.5 range. What would be a 3 stock? Yeah. What? Well, startup, it depends on what industry they're in. So I mean, a lot of a startup's risk is unsystematic risk. So we're talking systematic here. So Ford is a little tricky though, because you might say the biggest part of Ford is not selling cars, it's Ford Motor Credit. So is Ford an auto manufacturer or is it a bank? So it gets a little tricky there. But you know, there's more into this number. We're going to see how debt impacts that number and operating leverage. So there's more stuff in there. So Kroger right now is a grocery store with a lot of debt. Well, that a lot of debt's going to push its beta up higher than what you would normally think. So, all right.
So when you look up Ford and stock, you're really looking at the manufacturing and the credit thing?
Yeah, something we're not going to do, but something Dr. Damodaran talks about is the build-up beta. You essentially figure out a beta for each of the segments of the businesses. It's really tough to do. You really don't have the data you need. Because to do the individual pieces, you have to find a firm that is exactly like that segment of the firm. And the problem is GM also has the debt side, no, so it's hard to find a pure play. You look at a Facebook does a lot of different things. How do you build? So it's tough. I don't do that. He does it in his class. I just don't think it's, Disney would be a tough one. What's the beta of their theme park? What's the beta of their movie? What's the beta of their cruise lines? You'd have to do each of those individual. You could probably find a cruise line that's similar, like maybe Carnival. You get the beta for that. Then you got to do movie studios, maybe look at Paramount. I still think it's going to be a little questionable because then you got to adjust for their debt and all, so it's a mess. It's really, really tough to do. So you can calculate beta. It is that formula. You just get their monthly historical returns of the market. You can calculate a beta. But that's not what beta is. Beta is not a number you calculate. I mean, it's out there. There's no question. You can go to Lululemon. So is Lululemon cyclical or defensive? If you're worried about losing your job, do you run the Lululemon and buy everything they have? Maybe not. So their calculated beta is 133. That seems reasonable to me, but that's just their beta these last 5 years. That's not what you're looking for. You're going to buy Lululemon in the future. You got to know what their beta is going forward. So beta, just remember this, beta is a forecast. It's not a calculation. I'm going to say it's exactly the same thing as growth. So if Lululemon's growth the last 5 years has been 20%, would you use 20% for the next 5 years? No. You can look up that number though, right? Just because you can look at the number, that means it's gonna be your assumption. No, same thing with beta. Just because their beta has been 133 the last 5 years doesn't mean that's what you use going forward. All right. So it's not, this is the number. And I know a lot of finance classes, that's all they do is they go get the beta off of Yahoo Finance. That's not how you do it. All right. I joked that on my Facebook that I visited Columbia University. And I was walking around telling all the finance students that they can get their betas from Yahoo Finance. So we can, skew the competition because you're not going to do that. You're not adding any value. How much are they going to pay you to log in to Yahoo Finance and get that number and plug it into a formula? How much is that worth? You probably have 6-year-old nephews that could do that, right? And nieces and nephews can, you probably have nephews and nieces at 3 years old that could do that. So they're not going to pay you much for that. So the trick is this a reasonable number? I've seen Ford with a beta on Yahoo Finance of 0.65. Does Ford sound like a 0.65 beta company? Why was it so low? Just because of some noise. And one thing I'll say with beta is supposed to only measure systematic risk. However, it is possible for unsystematic risk to get into beta. If the stock market's up 4%, and your company just happened to announce big news on that day and it's up 10%, the beta calculation is going to think that's systematic risk. It's just not going to know. So it can have some noise in it that has nothing to do with systematic risk because it's a calculation with a lot of noise in it. But that doesn't look like an unreasonable number, especially for Lululemon that has very, very little debt. Yeah, I would think they would have a beta probably lower than some of their competitors. You can look at one competitor, American Eagle, they're 158. Does it make sense Lululemon's lower? Well, if they have a lot less debt, yeah, it makes sense that they're lower. So I'm not saying these numbers are wrong. I will say there was a period of time someone hit the wrong button, and for about 3 months, the betas here were all wrong. Someone went to the wrong line in the Excel spreadsheet, and they were updating completely bogus numbers, like 86.3. It's like, what, that number doesn't make sense. I don't know. They probably were one line off in their calculations. So what do you have to do? So I'm going to make you do this. We'll do Lululemon since I'm talking about it. Well, no, I don't want to do that. They don't have enough history. Let's do Walmart. So you're going to do this on paper 3, and there is a video that shows you how to do it. We're going to use monthly data Yahoo Finance used to do 3 years with weekly data. Now they do 5 years with monthly. I'll show you why I do monthly data. So here's Walmart's monthly data, probably back to 92 or something. They won't give you, they went all the way back to 72. All right, so here's their numbers. Well, I just dumped what they had in the download. You notice in the download, they leave a lot of this stuff out. Oh, that's right. Walmart just did a major stock split. That's pretty interesting. And you notice with the stock split, what does that do to the adjusted close number several years ago? Or well, maybe not the stock split, but the dividends. So this looks like 1 penny, but it's actually much more than that. Yahoo Finance used to was 1 penny. They actually rounded it to 1 penny. That messes things up because then you don't have any returns. So which of these do we need? We want the adjusted close because we're calculating beta. And if a firm pays a dividend, we don't want that dividend to mess up the beta calculation. So we want the adjusted close. And so what we're going to do is we're going to go get the market. Now to get the market, if you do this one right here on Yahoo Finance and do historical data, what button do you notice is missing? Here's the download button. All right, so you can't do that one. So what you're going to do instead is the Shift 6 SPX. When you do that, they'll actually give you the data. I think it will come up. Where is it? Did it go? Still not there. Did I not hit the button? So we're going to S&P in. It's from 1985, 185, so it doesn't give us much data. So I'm going to take Walmart and go from 185 as well. Because we have to have the same number of periods, right? If you do the slope function with different periods of time, it will give you an error message. So let's do the SPX here. Here, the adjusted close doesn't matter because the S&P 500 is a price index. There's no dividends, but it doesn't really matter for beta. It matters for total return, but it doesn't matter for beta. So I'm going to put the S&P in there. Now, my last month is March. What's wrong with March? It's not over yet. So I'm going to take March out of there. So I've got Walmart and S&P back 470 months. Do you think that's going to be enough data? Why do we know about Walmart in 1985 versus today? Well, it was a much smaller company back then. Small companies tend to have higher betas than bigger companies. So there's a good chance with a Walmart, you're going to see their beta starting really high and coming down. We'll see if that's the case. So we got to do the holding period return for Walmart. Y'all know how to do that, right? Holding period return for SPX. Can't do it for January. Why not? We don't have a beginning value, so we'll do ending value minus beginning value. There's no income because that's incorporated in that adjusted close divided by beginning value. Yeah, that doesn't look reasonable, but I guess it's possible. Same thing for the S&P. Here's my returns. And then we're going to do a rolling 5-year beta monthly. Why are we doing that? Well, because that's what Yahoo Finance does. Beta 5-month monthly, which means our very last beta better be 0.5. Because the very last beta we're going to do is going to be 5 years exactly like that. So we'll see if we get that. There could be a little distortion because we're using adjusted close and they may not do that. How many months in 5 years? 60, right? So let's go find month 60. There's 60. Oh, I did mess something up. What did I mess up? The month 60 is right there. All right, so now we want to do the beta of Walmart versus the market. So you're going to do equal slope. And which one do I do first?
The stock.
The stock, right? Real important. And then you do the market. How many of y'all think Walmart's a 1.3 beta company? Not, but that's what it was back in the 80s. We'll copy that down. I want to look at some ranges. So I'm going to do the 50 percentile, the 90th percentile, and 10th percentile. And use the percentile function. So the median is 0.54. That's getting closer to what you would think, doesn't it? The 90th percentile is 121. You're not going to use that. 90% of the time, or 10% of the time, they're above 121. 10% of the time, they're below 0.24. So I'm going to graph those down. And then let's look at the very last number. It's 0.49. What did y'all in finance show? 0.5. That's pretty close. All right. They might be using close instead of adjusted close. If that's the case, that could be the difference here. Also, remember I cut out March. They might actually be going into March to do it. So you might be off a slight bit. But if I get 0.82 and Yahoo Finance showing 0.5, I probably did something wrong. All right. So it gives you a good sense. And then what we're going to do is we're going to graph that. We'll just do a line chart. And here you see it over time, Walmart over time. Obviously, you got to put some dates in there. And when you do the dates, do we need the months, do you think? It's a little excessive, isn't it? So I'm going to change this to and then I like my tick marks, labels to be low. So here we have Walmart growing beta. You see two companies there, don't you? You see a small company and a big company. Which of these companies makes sense going forward? The small company with a high beta or the big company with a low beta? So I'd go here. Now, one thing you might look at this, if you see this with your firm, where do you think the data really starts making sense? You might say like in 2005, all right? So what I might do here is say, you know what? I don't want to do my median for the whole period. I'm going to do it from 2005. You may not do this with your company, but I'm going to do it with this company. 2005 starts in 241. So I'm going to change these to 241. And then when I do that, you notice now, oops, I hate it when Bill Gates says that. You notice now my median looks more to this period than the entire period, because a lot of students like to use that median as a good indication of what they want to do going forward. And so that brought my median down to 0.4. And I'm somewhat ignoring this period in my 3 lines, but I still leave them in there. I could just do the whole thing from 85, from 95, whatever I said, 2005, sorry, from 2005. I could have just started the graph there. So if you have a firm that looks radically different 30 years ago than today, then you might say, okay, well, I'm going to adjust this graph some, because essentially I'm saying we can ignore this. That's when Walmart was out in the country. You know, it's kind of what Dollar General is doing now, small out in the country kind of, but now they're a big city, massive store, much different business. All right, we'll practice a little more. You're going to be doing this on paper 3, so we can get some practice there. All right, I'll stop it there.